Ladies and gentlemen, welcome to this video. I called it Financial Secrets I Don't Want You to Know. And it will be about financial asset classes, allocations, basic considerations when it comes to investing and risk, as well as the current market environment. First of all, a little disclaimer, please understand, okay? I'm not doing this video in any professional capacity. This does not represent any type of investment advice. All I'm doing is I will just basically express my personal opinion. It may be correct, it may be incorrect. All right, you always need to use your own discretion. And I've tried to explain why I come to the conclusions I present in this particular video. But of course, any conclusions could be completely incorrect. Needless to say. Okay, so who should really watch this video? Well, anybody really. Whether you just have your first savings and you want to invest them, or whether you have a lot of money and you need to make investment decisions, okay, it doesn't matter. This video is for all of you, and I made this because I assumed that this would be a common knowledge until I learned that this is not the case. So that's why I'm investing time here in order to explain to you some really fundamental aspects. And I try to also be very concise, to not waste your time, okay, to summarize a lot of background knowledge into like a very concise presentation. And I will try to not go too far off topic. As you know, my work here in this channel is focused on foreign exchange trading, which is a particular area in all this, but this video is really a big picture perspective, let's say. And I will present knowledge which seems to be quite exclusive as well. Okay, so this is a bit of an index. So I talk about general aspects when it comes to managing your money in the investment area. And then we will try to apply it kind of to the current market environment. So the problem is these days with the internet and all that, there's so much noise out there. Yeah, you see people posting all kinds of recommendations. Yeah, you should buy this stock or that stock. You should buy crypto, trade forex, and so on and so on. So I really try to give you some structured overview here and to come to more rational, logical conclusions. So first of all, a bit of a reality check. And this may shock some of you, okay? The vast majority of traders loses money. The vast majority of investors loses money. The vast majority of ex-traders fails, over 90%, believe it or not. The vast majority of automated trading system fails. The vast majority of companies in general fails. The vast majority of startup fails. The vast majority of mutual funds does not outperform the indices. The vast majority of hedge funds does not outperform the indices. I provide more information on this later and why this is not a big problem for the hedge fund industry. The vast majority of hedge funds closes within 5 years of launching. So looking at those realities, understand what the base case is. Yeah. Whenever you try to invest, whenever you try to trade, whenever you invest in some vehicle, whenever you invest in someone starting a new company or an established company, whatever it is, the odds are against you. The base case is that this will not be a successful investment. And this has been proven again and again and again. Yet many people are not aware of this. Why? Because they see the possibility that the outcome is success. And of course success exists, otherwise this would be a sad world. But people underestimate the odds, the probabilities. Okay, in most projects the probabilities are against you. If you have a venture capitalist and the venture capitalist wants to allocate money to new startups, typically out of 10 investments, 7 or 8 will completely fail. And then, the remaining 2 will make up for all the losses because they will have higher profits in absolute terms. But, this is very important to understand. Now, understand also that when it comes to so-called financial experts, understand that either they do not have relevant experience, or they actually do not really have your best interest at heart. Okay, they try to sell you to sell you something. They give you some advice which is actually in their own interest, not in yours. So either way, whether you have financial advisors or not, you need to educate yourself on the most basic level. Okay, you need to have some knowledge, otherwise you will not do. Otherwise, you will not make optimal decisions. Obviously, in this whole area of investing and trading, it's all about risk versus return. And it's much, much more complex than, your return increases with risk. That would be easy. Okay, so it's essential that you define your personal risk tolerance, and I wrote statistically as well emotionally. You need to have self-awareness. With what kind of risk do you feel comfortable with? Okay, what kind of risk is reasonable regarding your particular circumstances? Then, what kind of risks are you actually exposing yourself to? Okay, your particular investment, is it subject to black swan risk? What happens if something completely unexpected happens? Does it all go down the drain? Does it lead to a total loss, etc.? And consider any potential outcome and scenario. Do not assume that you will be successful. Okay? You are often better off assuming the worst. And I've said before, I'm a big fan of Nassim Taleb. He has written the book The Black Swan. He has shown how risks are often underestimated in terms of nature and in terms of statistical likelihood. He has shown how we as a collective, as a society, we do not take into account what he calls a black swan risk. Such as, for example, a big stock market crash. Yeah, our institutions, our systems, they do not incorporate what happens if there are suddenly outliers, as we call them in statistics. Yeah, like big deviations from the mean of a particular distribution. And it's amazing how people do not incorporate that in their personal projects. So I think it would be quite interesting to look at some extreme cases on both sides, let's say. All right. And let's start with this popular case. There was Ronald Wayne, and he was actually the third founder of Apple. And as some of you know, what he did is he gave back his shares, which were 10%. I think he got $800 for that. And some people say that, he mainly wanted to get this investment off his books. He wanted to have like some, let's say, clean accounting. He didn't want to have some investments on his books, which he's not really following, or where he has not much passion. And the stake would have been $62 billion today. All right. So literally, he could have just kept those shares and he would have been a multi-billionaire today, because Apple became one of the most successful companies in the history of mankind. So yeah, whenever you have a bad day, look at those kind of cases and you will feel better. Now, he said later on, well, it was a rational decision back then. And of course, based on the fact that, as I've shown at the beginning, most startups, most companies fail, and it was not really predictable that this company would be such an amazing success. You could argue that, but at the same time, you have to acknowledge reality, and you have to say, well, there was no real downside. Maybe his shares would have gotten diluted and so on, but certainly, if he just kept the shares on his books and he wouldn't have exited the project, he would have been one of the richest men in the country. So, I mean, with hindsight bias, of course, we can say this was not a great financial decision. Let's continue. This particular case, so this was the richest Irishman. Let me just read this. Much of Quinn's cash was tied up in Anglo-Irish Bank, which he held 30% stake. Following some overly risky gambles alongside the 2008 financial crash, Quinn's fortune was sapped. Quinn had been taking out enormous loans from the bank to bet on changes in its own share prices. But when the 2008 crisis sent shares plummeting at alarming rates, Anglo-Irish Bank was nationalized and called for Quinn to pay his debts. This $3 billion debt, together with huge losses in Quinn's insurance company and the general decline of the market, left Quinn bankrupt in 2011 with more than $3 billion still owed. So I'm trying to show you here that things can always change, okay? Even if you made it, this doesn't mean that different rules apply to you. If you are over leveraged, okay, and you do not take into account risks you are exposing yourself towards, things can change in both directions, okay? And here you see a success story turning into a nightmare. Let's continue. This is a bit different, but still, you get the message. James Howells, an IT worker living in the UK, knows exactly where his misplaced 7,500 bitcoins are, but the city council where he lives won't let him retrieve them. They say it's against the law. According to a report published in The Telegraph, Howells began mining Bitcoin on his personal laptop in 2009. In 2013, after I had stopped mining, the laptop I had used was broken into parts and sold on eBay. He kept the drive he used to collect the Bitcoin, so if Bitcoin did become valuable one day, I would still have the coins I mined. But while cleaning his home in 2013, he mistakenly put it into a waste bin at his local landfill site in Newport, where it got buried. Now, with Bitcoin's value hovering just above 17,000, and we're going to look at the current Bitcoin price later on, by the way, which is much higher. Howell's 7,500 lost Bitcoins are worth more than 127 million, so that amount is much higher today. So yeah, another story. So he did some good decisions back then. He was early to see that Bitcoin could have potential, and he should have all these 7,500 Bitcoins. But things happened, and he's now struggling to get the money for them. Let's look at another example. Any CEO presiding over a loss bigger than the annual gross domestic product of Mali could be excused for seeking divine intervention. Yet SoftBank's Masayoshi Son, comparing himself to Jesus Christ, rings its own alarm bells. Japan's second richest man did just that on Monday while explaining how his Vision Fund lost a supernatural $18 billion in the fiscal year ended March 31. According to the Financial Times, roughly 10 billion of that Red Sea of lost value was related to ungodly losses on WeWork and Uber. So we can look at all these extreme cases, and you see, like, even if you're a billionaire, okay, if you expose yourself to certain risks or you do not follow basic risk management rules, things can change and you can lose it all and more. Fine. Let's look at some positive examples. And, everybody knows about Jeff Bezos these days. He worked for a hedge fund and then he started his own startup. He had the idea that, he could sell goods via the internet. The internet was starting back then. And today he's the second richest man after Elon Musk, depending on, how the assets go up and down. What I want to explain is, look, people don't understand. Those here are all his expeditions, okay? Different investments he has been involved in. So obviously, Amazon, when he started it, it was quickly leading to nice cash flow, okay? That's very important for any business. He was very soon able to sell certain goods via the internet, via the website, and then he expanded until today, where Amazon has become one of the biggest companies in the world and is selling anything you can imagine via the internet. Putting together the idea of online trading and the demand worldwide for goods, okay, and putting those components together, becoming one of the biggest firms. And Jeff Bezos in the process becoming one of the richest men. Of course, Warren Buffett is also known to most people who watch this. He's one of the most successful investors. At a very young age, he started to buy stocks, and he would just buy and hold those. He would just not sell them. He would just, continue to invest and buy and buy and buy. He stick to very simple investment rules. He only bought companies which he would really understand. Okay, and of course, over time, his wealth really increased, and he benefited also from inflation, from compounding returns, etc. Now, looking at the world today, looking at Warren Buffett, this concept may look a bit old school, let's say, and in particular when you look at people such as Chamath Palihapitiya. So many people say he is the Warren Buffett of the modern times, because what's going on in this world, ladies and gentlemen, is we have a shift going on. We suddenly have tech millionaires and tech billionaires entering the scene. Our society has really become dependent on technology. Silicon Valley startups have grown a lot, and so Chamath, he started by making Facebook big, and then interestingly he invested into several startups where most of those have become an amazing success. And he became a billionaire these days. His net worth is above, I think, $10 billion, and he's now a venture capitalist investing in companies which are relevant for humanity's future, really. Yeah. Now, he has made some amazing predictions, so I really recommend to follow him. And I think this is fantastic to see how things are changing in these days. Okay, so we have like an old school investment approach, but Chamath, he's not buying Coca-Cola or McDonald's shares. Okay, he's buying, he's investing into startups in the technology space mainly and beyond. And these days, where our society has changed a lot, where we have social media, where the internet has taken over, where fundamental things are changing in our world, let's say, we see that people such as Chamath are basically leading the game. Of course, we have to talk about Elon Musk, one of the big success stories of human history, really. I mean, he started PayPal, then he started Tesla, then he started the Boring Company and SpaceX. He's working on getting us to Mars one day, which is mind-blowing. One of the most successful entrepreneurs in human history, currently the richest man in the world. Obviously, all those rankings, they do not include people such as sheikhs and so on. But, I mean, in the official rankings, he's leading right now, an amazing person. And now, why do I show you all those examples? Okay, I've first shown you extreme examples of failure, and now I show you extreme examples of success. Well, because that's what we should do if we want to come to the right conclusions for, investing, risk-taking, etc. Now, some of you will say, okay, wait a second. As far as I know, Elon Musk, he took massive risks. He took almost all his money he made in PayPal and he put it into the next project. And if he would have failed, he could have gone back to zero. Yes, it may be true, okay? Elon Musk has certainly not done any diversification, okay? And we come to that later. And he has taken massive risks. And in several interviews, he said that he expected that to fail, okay? So understand that while retrospectively, we look at all these projects as huge successes, and he now has become the richest man, he took some really high risks. However, he did it in a smart way, okay? And remember that when he took those risks, he already had a lot of experience with starting companies, managing companies, etc. All right? So him taking those type of risks is not equivalent to somebody else taking those type of risks. So what I'm trying to explain is there are shades of gray. Okay? There are certain factors you cannot influence, okay, like some kind of endogenous risk factors, and there are factors you can influence, yeah, which are things that you can change or you can provide for. And that's the first big lesson in all this. But the reality is, look, these are extreme examples. Most people watching this, they will be in between somewhere around the mean. They will lose some and they will win some during their lifetime. They will have some successful projects or investments and some unsuccessful projects and investments. Only a very small minority would reach those outlier successes as the people have shown you in the previous slides. And only a very small number of people will also have those massive losses as I've shown you, before the success stories. So what I'm trying to say is we do not have direct control of the actual outcomes of our investment decisions, but we have control over our exposure, at least to some degree. So the decisions we make, and the risks we take, to a certain point, we can influence, from the bird's perspective, to what we are exposed to. And this is one of the key takeaways, okay? Now, whether for you, but in particular, it makes sense to take a lot of risk or to not take a lot of risks, that's a case-by-case decision, and we come to that too. And what I'm trying to do in this presentation is, I try to present to you a bit of a rational analysis, okay? And I'll try to enable you to come to the right conclusions for your particular case. And that's why this is not a one-size-fits-all solution, okay? There's not the right choice that applies to each of you watching this. But in the best case, and that can be said as a general rule, if your rational analysis, your gut feeling, your personal interests, and the context match, that's a good sign that you're on the right track. Anyways, in general, if you experience success, then the idea is that you also learn from that you stay humble, okay? Do not believe that you're the master of the universe and then you give it all back. Understand that your environment is dynamic. And in 2021, there's maybe true more than ever, okay? Things can change. Just because you were successful with something the last 10 years doesn't mean it stays that way, all right? So do not assume, but be prepared for changes. Be adaptive. This is the key. Be adaptive. And guess what? When it comes to failures, guess what? You will fail. If you're an entrepreneur, an investor, or trader, you will fail. You will have losing trades. Now, the idea is learn from those failures, okay? Do not just repeat the same mistake over and over again. Learn from it, adapt, improve, change, okay? But do not fear failure as such, right? Because as you can learn from all these people I've shown before, they all have had their failures, okay? But nobody talks about that anymore. But those failures enabled them to learn what to do better in the future in the next project, and then to have a big success at some point. Now, at the same time, while you shouldn't fear failures and why you should learn from them and why you should not give up and stand up and improve, of course, it's needed that you also practice some damage control, right? If things have gone horribly wrong, okay, then often it makes sense to get into a mode to limit the damages. I always love this example, not only because Ray Dalio is an amazing person and you can learn a lot from him, we all can. But look, today he's one of the biggest hedge fund managers in the world with Bridgewater. He's a multi-billionaire. But nobody talks about the fact that when he was in his mid-30s, okay, he almost completely went broke. He had to borrow money from his dad in order to continue his fund because he was completely on the wrong side. He was overexposed. He almost had to close down completely. But he didn't. What did he do? He learned from the mistake. He learned that he was way too, maybe also blind or arrogant. You know, his analysis was not reflected by the market reality back then. And he adapted. He became very humble. He created a system where, he would select analysts and people working for him and consider the opinion and conclusions of all these people as a collective. So he was improving the investment process. And guess what? He was able to turn his fund into one of the biggest funds in the world, one of the most successful ones. And of course, this is a story we all love. And I recommend you to follow him and to read his book called Principles, because this is amazing to learn for all of us, how we can make better decisions in our life, in finance and beyond. Now, so one big aspect, of course, in all this is risk tolerance. You need to define your tolerance for risk. Okay? It differs. My tolerance for risk may be higher or lower than yours. Now, the important thing is you need to make conscious decisions. And most people, they don't even do that. So most people, they don't even define the tolerance for risk and respective outcomes and scenarios and can find themselves in. And secondly, they don't make a conscious decision. They just go with the flow, and that's not good enough often when it comes to investment decisions where you need to have some kind of rational analysis also. Then once you have defined the exposure, take ownership of it. All right? Whether it works well or not, own your exposure. And then, of course, optimize your risk factors. If you are too heavy on one side, you may want to change it. We come to that now. Of course, there are all kinds of relevant factors when it comes to your risk tolerance. Okay, your net worth, your liquidity, expected expenses, exposure and tolerance, risk tolerance, age, willingness to invest, time, very important, we'll come to this later, personal interests, etc. Yeah, all these are just examples for the factors you should consider when you try to define your risk tolerance and whether you are happy with whatever outcome your particular investment decisions may lead to. If you're completely overexposed in something and if you maybe even depend on something working out, often there is no balance and often you're not even aware and you're not happy with that kind of exposure. And that's important. So whether you are an entrepreneur like Elon Musk and you basically take all-in decisions because you're so confident that it will work out, or even that you are happy if it doesn't work out, but you know that in either scenario you will not regret your decision. For you, it could be the right choice, for example, to not diversify much and to have concentrated risk. But if you are someone who, wants to stick to some baseline if things go up or down, it could be that you should have some degree of diversification in your overall allocation. As simple as that. Know yourself, know what kind of person you are and what is better for you in general, for your happiness, for your health and everything, really. Okay, fine, good, we got it. Now let's look at particular investments which are popular these days. And here in this table you can find different types. You find single stocks, the average return between 6-7%, but high volatility. There can be a total loss. Some stocks can also delist. Fees tend to be rather low. And the capital intensity is also rather low. So that, for example, is an investment which could be a good choice for people who are willing to put in the time. We come to that soon. Mutual funds, most of them, they are not able to outperform the markets, okay, but they can reduce the volatility of the investment. They can, for example, give you diversification which you cannot afford yourself. If you only have like a certain amount to invest and you can't really replicate a stock portfolio, by picking those kind of vehicles, you may actually be able to have some more diversification, so less movement in your investment. But often the fees are not justified and often they lose against the index. Index ETFs which have become popular. Now, generally speaking, they can be a good choice because they just replicate the index. But of course, you have full market risk here, and this is a big topic of this presentation. If the market goes into a bear market for several years, you will be in drawdown, all right? But it's a vehicle which allows you to get exposed to the market for low fees, generally speaking. But the current market environment may not make them as attractive as they were, and you will see soon. Real estate, people underestimate that real estate as a category is not easy, okay? Returns on a net basis don't seem to be as high as people think. There's actually more risk than people believe. Okay, it's very capital intensive, and it can also lead to a total loss. And many of those things are true for real estate funds as well. Yeah, so there are studies on that. But in my personal opinion, these are very particular investments and not suitable for most people. Bonds, well, these days the returns have gone really low. They don't impress much. They are not very tradable. Okay, it's more for long-term investing. I show you later on also a bond ETF. It has done fine in the last years, but because bonds are generally speaking more for institutions or investors who already have a portfolio, okay, who are happy to have the money locked up for a few years and to have a return which is not, exorbitant. Metals such as gold, we also have full price risk. Okay, there can be big losses, like I show you later on the chart of gold and silver as well. So when you hear people, oh yeah, buy gold and so on, it depends. Okay, you take full market risk. It's also a long-term investment at the end of the day. Wealth managers, well, most of these, they have their own interests. Most of them, they never beat the market. They may try to actively manage a portfolio, and often they do worse than a passive portfolio. However, especially now where markets are highly inflated, that could be more interesting than in the previous market period. Startups, very risky. Most of them fail. Okay, so you have to be prepared for that. Can lead to a total loss. Okay, very capital intensive. Obviously, if it works and succeeds, it can lead to a massive return, as we have shown in the presentation before. Oh, there we go. That was a lie. Nice. Hedge funds. Okay, that's a topic on its own. Many hedge funds, they do not outperform indices. However, like as I will show in a minute, for big investors and also institutional investors, hedge funds may be a way to reduce their overall volatility and market risk. Okay, so if they find strategies that are not correlated much to the overall market, if the market turns down, those funds could be up, which could even out the volatility of their portfolios, for example. So there's a place for those. But most hedge funds are not accessible to the average investor anyways, okay? This is more for the big boys, let's say. Crypto, which has to be added to the list these days, returns massive. We have never seen such returns in traditional investment classes like, for example, Bitcoin over the last 10 years. Of course, high volatility, they can move back and forth, high risk. Fees, I would say medium. It's not as cheap as trading Forex, for example, but it's not super expensive neither. And I should do a video only on crypto, but obviously it seems that in 2021 crypto is there to stay. Okay, it's not just a hype which is going to disappear anytime soon. Okay, so this particular slide should make you understand that there are those people and entities, okay, they already have a diversified stock portfolio. They already have diversification. They already have bonds. They already have commodities. They already have startups or private equity. They already have real estate exposure, okay, etc. So for them, hedge funds may be a great satellite, let's say, in such a portfolio, especially if the hedge fund strategy is not much correlated to other asset classes. So that means if other asset classes turn down and this particular hedge fund strategy goes up, that's what they're looking for. Not necessarily that the hedge fund can beat an index, for example, because they may already have exposure to an index, you understand? So, but of course, the hedge fund industry has gone through a lot of pressure in the last years. Fees have gone down, and the industry has changed a lot. Strategies become more quantitative. But I think there will always be a place for hedge funds. Okay, but for most people watching this, you have a jungle out there, right? You're bombarded with marketing, you're bombarded with people giving you opinions and YouTube videos and whatnot. And for most people watching this, those kind of instruments here are not suitable. Okay, futures, options, CFDs, certificates, and so on, forget about that. You will lose money, okay? So in terms of the actual exposure and the expertise required for these things, stay away. You will just join the majority of losing in those kind of markets. And by the way, this here should also actually incorporate Forex, but we'll come to Forex later. So to make a long story short, for most people watching, it boggles my mind that they don't come to the following conclusion. Okay? And this is one of the most important slides here. I should actually make a note somewhere. You can go to slide 27 if you want to skip the general knowledge part. If you are someone who just has some money to invest, or if you are someone who has cashed in something and now needs to make investment decisions, In a nutshell, these things here are relevant. And I'm not talking about short selling anything, okay? I'm talking only stocks, buy and hold. ETFs, buy and hold, maybe even bonds, but for most people that will not apply. And also crypto. So when you look at the jungle and all the products out there and all the exposures and all the noise, and you cut it all down, the reality is this here. For most people, it makes sense to own some stocks, to buy and hold those stocks, not day trade them, okay? Otherwise you will lose. Just buy stocks, and I'm not talking about penny stocks neither. I'm talking about established companies, more boring companies, which have already achieved a certain size, maybe which also pay some dividends. So your chances of success are highest if you have a selection of those kind of stocks. There are ways of buying them cheaply these days with several brokers, and to just hold them. Okay, not day trading, hold them over several years. Generally speaking, because obviously today the markets are inflated, and we come to why it's not that easy anymore today. But generally speaking, and this was valid for the last 10 years certainly, stocks are a good instrument. Why? Because in the worst case, you can have a total loss or a delisting if the company completely failed, and most companies do not completely fail and delist. All right, I'm talking about markets which are, stocks which are part of an index. So in that particular selection, only a small number of stocks will delist over a certain time period. Okay, so basically you're benefiting from some kind of pre-selection. But of course, there's correlation on the prices of stocks, and this is another issue. I call it the correlation crisis, that because of algo trading and other realities, stocks tend to move together a lot. So you think you have diversification, but basically, effectively, you have exposure to the same market risk factor. But as an instrument, okay, this is interesting. Why? Because, look, it's not that you can get a margin call. In the worst case, stock price goes against you. In the worst case, you hold it for several years, maybe half a decade or longer. But if you pick, let's say, 10, 20 stocks and you invest in them over time, so you don't buy everything in one go, but you invest in several stages, and they may pay you dividends, etc., there's a good chance that overall, you will have some return, even if some of those stocks go down or flat. But unfortunately, with the markets of today, which are completely overinflated, it's not that easy anymore. However, in general, as an instrument, it's still attractive. ETFs, yes, you can't really get around ETFs because, look, there are all kinds of ETFs these days. Thematic ones, ETFs, exchange rate funds, which replicate a certain index, which are concentrated on certain sectors or markets, etc. Some of them, they are cheap to trade as well, but be careful, there's sometimes inbuilt fees and so on. And of course, there's also some market correlation. But these days, you can yourself, without someone doing it for you, you can yourself have exposure to ETFs. You need to, of course, make your research, select some good ones. The same, I'm not talking about trading them. I'm talking about buying and holding them. Okay, selecting them, buying them, holding them for the long term. Bonds, as I've said before, remember, bonds, depending on their rating, can also lead to total losses. Depending on also what their rating is. AAA tends to be safe. The interest, however, the return tends to be low, and they tend to be capital intensive and long term. You need to hold them for a few years. But for some investors, that may be a good allocation as well. Not so much for private investors. Crypto these days, as I said, we can't ignore crypto. Yeah. Crypto is accessible. You can also buy and hold it. Do not trade it. Do not buy it on margin, okay? Don't. It won't work out. And certainly don't try to short-term trade it. There's not enough data in existence. But as buying and holding, buying some crypto and just hold it for a few years or even longer, yes. So no matter what people tell you, okay, what people come up with, the truth is, on this particular slide 27, these are the 3 or 4 main choices you can approach, even if you're not a financial professional, but if you put in a basic amount of research and and you follow some very simple rules, such as not investing everything in one go, doing so over time. So this is very reachable for most people, okay? If you're willing to invest the time, you don't need someone to do that for you. If you have some basic interest, you can do that yourself, okay? You need to invest certainly more than, let's say, 20 hours, but it's not that you need to invest like 5,000 hours neither, okay? And be aware that your strong point is the time frame, okay? That you can hold it for a few years. Don't engage into complicated stuff such as short selling or derivatives, etc. Now, Forex trading, now understand, okay? So, and I've always said it, and it's very important. Manual Forex trading requires between 4 and 9 years to become profitable. Okay, automated Forex trading similar. So first of all, automated Forex trading, for many people, it will not be reachable in their lifetime. And forget about buying commercial EAs and all that, okay? That won't work. So that's a very particular topic. But even manual Forex trading, everybody can open an account, place money, and start trading Forex. That doesn't mean that you should. I've always been very, very clear. Only a small minority will succeed in FX trading. And respect that. If you believe you should be part of this minority, you need to put in the hours. And for most people, it means beyond 10,000 hours of time investment. Plus all the accounts, you will may have blown and so on over in the learning process. Okay, and let me stress it, because look, of course, I am specialized in Forex, but I do not want to promote Forex Forex trading to the average person out there or watching this, because the average person will not succeed in that quest. And of course, when you look at it on a factual basis, I mean, look, Forex is a highly liquid market, there's low transaction costs, it's open 24/7, there's a lot of tradable price action, it's an accessible market, the market direction is not relevant, we have like little stock crashes, so to speak, every single day. That seems all very attractive, but the truth is, extremely high degree of market manipulation, and of course that's the focus of my work on this channel. I'm specialized in re-engineering, exposing the market manipulation of FX. Watch this channel, watch my videos, okay? And we are offering live stream access that you can actually have a chance against competing those unfair manipulation practices. But we are not directing this at the mass market, okay? So understand that. And I'm certainly not, just in order to advertise anything here, trying to convince you of a different reality. The truth is, even if you have access to the live stream and so on, you need to put in the hours, you need to study, you need to practice, you need to put in the work. Otherwise, you will still fail, okay? You need to develop your own edge, which means you need to really put in the hours and get the education. On top of that, there's broker manipulation. The markets are complex, and as it's proven, very low odds that you will succeed. And there are barriers to entry, not in terms of laws or something. Everybody can open an account, but in terms of what's required to succeed. Okay, testing, preparation, knowledge, etc. And it will require a high degree of effort, time, resources from your side. And entities who are out there just to lure you in, they want to get you to open an account and place money and lose it. They try to convince you that it's easy and it's unethical. And I'm trying here to make you understand that this is not reality, okay? So my clear advice, even though I promote, like the market causality and the live stream access, make no mistake, this is not for the mass market, okay? For most people, Forex trading, successful Forex trading is not within reach. That's a reality. And most likely, if you're watching this, you're one of them. So accept that, okay? There's still other things you can do. You can buy and hold simpler asset classes. You can diversify, you can invest in steps, you can stay away from all kinds of complex instruments or complex trading, okay? And you can still have a positive expected value. However, at the same time, and I want to be honest, this was particularly true for the last 10 years. Now it's getting difficult because markets are completely inflated. So you need to open your mind. But understand that only people will succeed in Forex who are completely passionate about the game. Otherwise, they will also fail. So be honest to yourself. Are you really, really, really interested in Forex? If yes, give yourself a realistic chance by setting yourself up correctly, for example, with the market causality, study it, and then work on this skill. And be happy with like investing a few years. On the positive side, it's a skill nobody can take away from you. So you would say, well, that seems like an optimal combination, especially because those things here, they only take a limited amount of time. They don't take like 10,000 hours. You can buy good stocks, hold them, buy good ETFs, hold them, buy some bonds, hold them, buy some crypto, just hold it. So it's not that you need to work on it 10 hours per day. And then the time you have, you can use for the active short-term trading in Forex and benefit from all the positive aspects such as low transaction costs and a lot of price movements, etc. Well, yeah, generally speaking, yeah, it's a good combination, okay? But this side of the equation, yeah, the Forex trading is only within reach of people who are very serious about it and who have some edge like the market causality, so they don't get stop hunted straight away or position hunted by the smart money, as I've shown many times. Okay, so for most people who are watching this here is what they should limit themselves to. Okay, and I'm not saying you need to have a fully diversified stock portfolio or something. Okay, and you don't need every ETF which is out there or anything like that. But you can, create a reasonable exposure. That's the point. Excuse me. You can create a reasonable exposure yourself with a reasonable portfolio of those components. Something which has upside if things really go in your favor, and something which at least has some balance when things go against you. And this here is only for the ones who are really determined to make it work and who have mastered also the market manipulation. Okay. And of course, for myself, my focus is this work. I mean, this channel is mainly about Forex, and I also personally do automated things. So, but I have invested the years and years and the thousands and thousands of hours to get there. And now I'm offering also those tools based on the pre-work so that other people can also use those tools at their advantage and they have an edge in this unfair game. But understand that opportunity cost is a big factor because the amount of time you invest into a project could be invested somewhere else. So do not underestimate the high opportunity cost for any kind of active trading for that matter. Whenever you want to trade in the short term, you don't want to invest like over a multi-year time horizon, you face the reality that this requires a lot of work, a lot of preparation, okay, and therefore a lot of opportunity cost. Maybe you were better off investing your time into a little startup than trying to become a short-term trader, whether it's in Forex or stocks or other instruments. You understand? So be honest to yourself. Know your degree of commitment. Do not just try to trade Forex because you think that will make you rich. It will make you poor, not rich. Many people don't even consider that. So diversification, well, it's common sense that some degree of diversification is good. Don't put all your eggs into one basket, they say. So if you put everything in one particular thing, you're taking massive risks. Okay, if you put all your money into one stock, even if it worked in that particular case, you took a massive risk. If it would have gone down or even delist, you would have lost everything. So be aware of those realities. Don't try to convince yourself otherwise. Be aware of market risk and correlation. That's a big topic. Many asset classes these days are much more correlated than you would think. Stocks across the board tend to actually move together. Before years ago, that was different. There was more diversification in the sense of, okay, those stocks go down, the other ones go up. These days, also because of algorithmic trading, we come to that now, things tend to move together a lot, which is a big problem because then effectively the diversification you think you have is not as high as you thought. Okay? And in all that, of course, as I said at the beginning, the risk tolerance you have is very, very important for all of this. Okay, because that also determines how much diversification you optimally should have in your investments. And again, the passion, very underrated factor. If you're someone who just loves to analyze annual reports, okay, or certain industries or companies, of course you can turn that into, analysis which will help you doing better investment decisions than someone who just has money to invest and is not really interested in a particular sector, let's say. Okay? And in the extreme case, if you think you should become a short-term trader or forex trader, you need to have passion. Why? Because otherwise you are not willing to actually invest the time, effort, and resources that are required in that particular quest. And I've said it many times, and I will always say it. I will tell the truth here, whether you like it or not. I will not change the truth just to sell something. Forget about that. Okay, I have certain ethical principles, I will follow them. So the truth is, and I tell you that with someone who has really lived and breathed Forex, the truth is you need to be determined, because otherwise you don't end up in the 1%. You will end up on the other side, in the majority of market participants. Okay, it's also important to come back from failures. Like if you are not really, really interested in what you do and you fail, you will not stand back on your feet. You will change and you will go to something new. Okay? So that's also important. And last but not least, as I said before, be aware of the opportunity costs. Maybe you're better at something else. Okay, that's all great. But now let's come to the next difficulty. And that's slide 35. Because let's look at the actual market environment today on the 28th of 2021, February. And that makes things even a bit more difficult, to be perfectly honest. Because, as I said before, we're in a situation where markets are highly inflated, and we look at them now. We are just at the end of the first COVID pandemic. I mean, understand what that actually means. We had lockdowns across the world where whole economies were shutting down. Businesses were shutting down. Companies were shutting down. People were not working or working from home. This is a situation we haven't seen since the Second World War, really. And yet our markets are very high. So like that alone must make you very, very skeptical. Even if you're not a professional, even if you have no clue about finance, if you have common sense, and you see the high markets I will show you now, together with those crushed economies, you will see, okay, something is going to happen here. And apart from that, we are in the time of change, okay? We have massive changes to the financial system. We have the cryptos coming up, something which was unthinkable before, alternative currencies. We have technology firms coming up, the big tech firms, taking their place among the big banks and the industrial military complex, okay, becoming massive companies. Therefore, we have also a shift in wealth. Of course, we also have geopolitical power shifts already before the pandemic. Asian countries becoming bigger and stronger, okay, competing with Western companies, for example. Then, of course, on a macro level, we live in algorithmic times. We have like a lot of algorithmization of society, okay, robotization of society, quantitative approaches to all kinds of parts of society. Things are changing. More and more things get automated, okay. Today, if you pick up the phone, you talk to some service provider, it could be that there is like a robot voice on the other side of the phone that was unthinkable before. The internet is taken over completely, obviously. Yeah, social media, YouTube. Okay, people are communicating online. Work is done online. Okay, checking your emails has become like the normal start of the day in most jobs. Knowledge is also available online, of course, on a positive note. So there's not so much exclusive knowledge anymore. Okay, there's an abundance of knowledge and information, and this is amazing. Now, at the same time, when it comes to financial markets, we are in a period where we had massive central bank intervention and price manipulation. We come to that. The emergence of algo trading, as I've said before, over 70% of the volume in stocks is traded by algos, not by human hands. Understand that. And resulting with that, we have some kind of correlation crisis where stocks suddenly, not stocks, stocks are suddenly moving together with bonds where before, they used to be negatively correlated, or, gold moving together with stocks and oil and so on. At the same time, more and more markets have become accessible. Okay, we have products which are accessible to almost anyone. Okay, where people can cheaply invest or can also trade and so on. We have a structural decline of banking, including investment banking. This has been gone on for some time, but things are changing. Okay, more and more robots are taking over. Less humans are needed than before. There is not so much exclusivity anymore, so that means like fees are going down. Okay, all this is changing the industry. We have the cryptocurrencies coming up, which will also change banking. So this is the environment we have to face right now. So here, don't take my word for it. CNBC, Fed to pump in more than $1 trillion in dramatic ramping up of market intervention amid coronavirus meltdown. Well, don't forget this chart ever. Look at this chart. Money supply growth this year has been the fastest on record. Now, the one thing I don't like about this chart is that this looks as if, because of COVID, suddenly this exploded. Look, before COVID, central banks were already massively printing money, okay? Already massively. And then with the pandemic, as they call it, it completely went out of control. Central banks have printed money as never seen before. And this has pumped up all financial markets across the board. Okay? In the weeks from 26 February to 10th of June, the Federal Reserve balance sheet size jumped to $7.17 trillion. Central banks rapidly expanded their balance sheets. Okay? Here, European Central Bank, Japanese one, American one, Bank of England. So what has this led to? There you go. This is the S&P 500, okay, the American stock index. And even if you have no clue about investing, I mean, look at that. I mean, this is 2011, right? This is March 2011. This is today. So we have a massive increase in the stock market. Of course, we had the big correction last year, the V, going all the way down and then going back up. And retrospectively, look at that. This was 2018. If you would have bought here, you could have gotten better prices than in, let's say, 2016 and have the equivalent return in a very short period of time. But it's hindsight bias. But the big takeaway is, look, the S&P is at 3,810.05 points. 2011, we are talking around 11,000 points. Almost tripled since then. Now, why is that? Why is the market so high if we have like the pandemic going on and the economic numbers now getting affected by this? There's always a bit of a delay, obviously. Well, central bank market manipulation. Okay, they have a mandate, so they pump the market up with money. They push the prices of the indices up. Okay, this is a result. Now, what people don't understand is that even though this looks phenomenal and you think, well, stocks are the way to go, they don't understand that we can have bear markets over several years where the market will go down, 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 and that now with the effects of the COVID crisis looming, the risk is very high. You understand? They don't know that. Look at this chart. This shows you better the cycles and the returns you can suffer from when you buy on high levels. Okay? we're talking about a situation that when you buy the index or you buy stocks which are part of the index and you have market risk, you're taking a lot of risk. Because if in the next 20 months or a bit longer or shorter, the market finally collapses and the central banks don't hold it up anymore, and prices go down of all the major stocks, and because of the correlation across markets, everything turns down. If you bought now at those high levels, you may get stuck for 6-7 years, or maybe longer, maybe shorter. But understand what I'm trying to tell you here. And financial professionals, they don't tell you that, and I don't like that. Okay, it's very, very risky to invest now. Now, of course, if you buy the S&P now and it maybe goes up for another 6 months, you may say, well, I could have missed that. It may work, but if you did that and it worked out, it was at a massive risk. You bought massive market risk and you could have gotten stuck there for a long time. And that this can happen seems more likely right now. Dow Jones, take a different index, okay, just the 30 companies. Still, look, this is 2006. But again, look at that. Look at 2007 down to 2009. Those 2 years, the market just went down. It did pullbacks, but overall went down. You see, from like 1400 all the way down. And then at some point recovered. You understand? And today we are at 30,908 in the Dow Jones. Can you imagine? Now let's look at some single stocks. Amazon. We talked about Jeff Bezos before. Look at that. Look at that. Trading at $3,090. This is 2000. These are the last 2 decades. If you had that stock in 2000, you may be very happy because you made a massive return. Okay? Like some of you, times 30 and more. Think about that. Times 30 and more. Amazing returns. But now, today, and this is a monthly chart, do you want to buy here? Do you want to assume it goes up again? Maybe it does. But what if it goes down here and corrects or goes sideways for 5 years? That's the other thing people really, really underestimate. Back then, when I was a stockbroker and investment manager, it bugged me how many stocks go sideways and do nothing over years. Not only going down, but doing nothing. Can they go sideways a few years? Of course. They don't need to crash. They can even just go sideways. Apple. And mind you, this is a stock split. It's not that the stock went down. Make no mistake. Okay? Look at that stock. 2007 here. Trading at 14.2. Okay. Today, 121. After the stock split. Before the stock split, 515. These are amazing returns. Amazing returns. Microsoft. Look at that, 26.5, 2009, 231.93 today. This is a great return, more than 10, a bit less than 10 times increase. That's incredible. Not 100%, 1,000% then. Facebook, when I was a stockbroker back then, I recommended people to buy it before 2013. And they must have been happy. Some of them, they got it at $39. Today, $256. But I'm not so bullish on this particular one. And it had some corrections, but still, the overall performance, amazing. Tesla. Look at that. $214 in 2016. $2,319 before the stock split. After the stock split, $673. What a success story. Incredible. Incredible. Now let's also look at other shares beyond the US. Adidas, German. And look at that. Yeah, below $86, $287. It's not that every single stock went up. And of course, look here, there was a big down move, big house cleaning. But still, on a macro perspective, we talk about big increases in asset prices. London Stock Exchange is a stock. British. $30.6 to $96 times 3. Wow. Okay, let's look at other asset classes. Bonds. This is a bond index. Look at that. From 10,000, just about 40,000. Also just went up over 10 years. Gold. In all fairness, look, it had a big correction around 2011. Okay? It's not that it just went up. It's not that simple. But still. Look, this was 2001. It was trading at 278. Today, 1,734. Still more than 4 times increase. Okay. Of course, there was a correction, and look again. Look, the correction was 2011 to 2015, 4 years. But after 4 years, it again broke the high. Silver, a bit more complex. Look, it was trading at 49.8, almost $50, 2010, then came all the way down to around 11.5, now at 26. So that's a bit more complicated. The same with oil. Okay, oil was around 144 in 2006, 2007, and then consolidated now at 64.26. ETFs, like this one. Look, the Global Clean Energy ETF, nice one. But look, can you really buy it? It seems kind of high. It's a weak chart, 33.8. Look, it was a 10. Renaissance is also thematic ETF with selected stocks such as Uber and Zoom. Look at that, from 30 to 66, more than doubled. Genomic Revolution, also thematic. Look, on the week chart, tripled. And this is a blockchain ETF. Look, Feb 2018, below 26, now 50. That seems high indeed. Then I like space investing. This is space ETF. High 29, but you know it has been it went down before at least, so that maybe can be considered possibly. Same like this one, the solar ETF. Did a huge increase, looks expensive, but maybe in the grand scheme of things, looking at 2008 and so on, not that high. But I mean, look, across the board, we are inflated. Look at that, Bitcoin. If you want to feel bad, look at this particular market. I mean, I have my own story. I should put it in another video. I can't put everything in one video. I will maybe do one on Bitcoin only, my own story. But I mean, this is October 2014. Was trading below $1,500. Today, $45,440. The high was at 57,000 a few days ago. This has made millionaires, guys, and I have my own set of stories. I know someone who became very rich with that. People who lost as well. But incredible. Those kind of returns, even respectively with hindsight bias, amazing. My personal opinion is cryptos are there to stay at this point. We just had Elon Musk buying Bitcoin with Tesla. This was a big step. And I think at this stage, even people who still don't get the message, like Peter Schiff and so on, they have to wake up to a new reality. Okay? Cryptos are here to stay, and they will change the system. But that's a topic on its own. I don't want to get too far off topic. Ethereum. Look at this. 2018, December, 127. Now 1,425. Now, fine. So markets are high. Of course they can crash. Of course. And when it comes to Forex, the good thing is we don't really depend on the market. Of course, there are correlations between equities and the dollar and, let's say, euro dollar as a consequence, for sure. Recently, we have seen, for example, Eurodollar moved a bit together with, let's say, the S&P. Okay, but generally speaking, first of all, when we do short-term trading, we have stock crashes every day. We have markets which go up, down. It doesn't really matter what the overall market direction is. It matters what kind of strategy you have. Not that it's easy, because it's super difficult to find a good strategy. But the attractive part is we have moves every day. It doesn't matter whether things go up or down, really. And in particular, markets are fractal. Okay? If you zoom in, there's a certain way they move. If you zoom out, there's a similar way they move. So if you're able to exploit the shorter moves, of course there's potential, but you need to know what you're doing. Otherwise, we'll just lose. You get whipsawed, you get kicked out. Now, hedge funds, as you can imagine, last year, 2020, some of the big hedge funds had the worst year ever. Why? Because of the V in the stock market. That's one reason. Whether they were short or long, they get whipsawed. And that was a very weird move where it just went down and straight up again because of the central bank manipulation. Most big funds got it completely wrong. Okay? Even the best ones. Renaissance, one of the worst years ever. Lost 20%. Even Ray Dalio, one of the worst years ever. Since then, they've recovered a bit. And overall, the index, it has recovered a bit. But of course, the reality is most hedge funds have some stock market exposure, stock market market correlation. They claim they don't, but many do. So if the market goes up, their performance goes up. That's a big problem. Understand that. There will always be hedge funds, but the industry will also change. Strategies get more quantitative, more diverse, and the easy game will die out, where people just actually select some stocks and the overall exposure is similar to an index. These things will not be part of the future anymore. Okay, more than an hour. I think that's enough. So what I want to tell you is, first of all, do not assume that things will continue as they did just because we're still in a decade-long bull market. On average, a market cycle is around 7 years long. We are now far beyond that. There's many fundamental reasons why things change. So people start to realize, we have the damages from the COVID coming in. This will impact the economy. The people have already lost their jobs. We're going to have inflation pressures from effects such as crypto, where people are cashing in and putting the money back into the system and so on. In general, the wealth shift to tech companies and tech millionaires, tech billionaires, inflation pressures coming from that as well. We had a situation where the markets are so high, as I've shown you, that the incremental risks are very high. Now, when I look on YouTube and I look at people who talk about their portfolios and investing and so on, they have never lived through a bear market. They have never seen a bear market in their lives. They think that's how it is. Our stocks go up. Even though the analysis shows you that, no, there can be 6-7 year long bear markets. There can be huge corrections. There can be crashes. Okay, and what happens? They get stuck and they enter a huge drawdown over several years. Because they think, I learned in the last years, this is how it works. It has done well for me. They're not adaptive. They can't think, wait, I was lucky that I was on the right side, but now things can change, so I need to adapt. And understand that being in cash is a position that can be good. Like there's some people that have like some kind of allergy against cash, like not having a position. Of course you can lose in terms of inflation, but for most people it's no problem at all to be in cash for several months or half a year, even if they lose on inflation. Because the decisions and the optionality they get by being able to wait what the market does can be of much more value than having some short-term gain. You understand? When I was a stockbroker investment manager, the only people who were making some money were on the, let's say, buy side, like normal people, were the ones who had the patience to wait for market crash. And then they would have a selection of some more boring stocks and buy them in certain steps. Okay, the market came down, there's a pullback, crashes again, they start to buy a bit. Goes down again, they started to buy a bit only after the crash. And then suddenly when the recovery came, they made huge gains. This can be done, but you need to have the patience. And if you wait for half a year, 1 year even, it doesn't matter, okay? But the ones who have the patience to wait for the environment to change, they often have an edge. Of course, if you say, well, I was lucky, I had stocks, I will cash them in the next half a year, I will have cash to invest, I don't want to go back into stocks, I don't want to get back into bonds or ETFs, I want to learn short-term trading, that can be a right choice, but understand that the odds are completely against you, okay? You're starting from zero. Just because you had some stocks and you were lucky, or some ETFs, doesn't mean you have any knowledge about FX. FX is highly complex, okay? And then give yourself a realistic chance, for example, by subscribing to our tools. A bit of advertisement here, if you want to call it like that. Give yourself a realistic chance, otherwise you'll just get stop hunted and position hunted, and you will be fresh meat for the smart money algos, okay? Set yourself up for success, like start demo trading first. Learn, study all the free material I've published on this channel and elsewhere on the website, okay? Use it. I've done so much for free, which is accessible to the world for free. Study that first. When you're ready, then subscribe, so you can also do things live. But use everything I've put out there for free. Leave me a little thanks and prepare yourself. If you're serious about it, if you're not really serious about becoming a real trader, then stay away. You're better off. You don't lose time, don't lose nerves. Do something else you're passionate about, okay? If you're not really passionate about the trading, don't try to convince yourself. Stay away. Otherwise, you will just be a failure, another number on the victim list of the smart money. Don't do that, okay? Be honest to yourself. Either way, whatever you do, have a clear plan in place, yeah? Covering those asset classes. If you made your analysis and you are super, super confident that the markets will just increase, that the central banks will continue to print money, that things will stay like that, and therefore you have your stocks and you want to just hold them for another 1 to 3 years, okay, do it. Just be aware that there is a massive risk, The markets can turn and maybe not come back for a few years. If you're happy to take that kind of risk, or if you say, well, you know what, in 3 years I will have another money to invest, so it doesn't really matter. Okay, it can be a right choice for your particular case. But be aware of those risks you're taking. Don't try to convince yourself that just because everything went up over a decade, that this will continue. Okay? Try to be realistic, right? And if you're somebody new just entering the market, ask yourself, are you willing to buy stocks at those prices? Are you? Okay, maybe it just continues boom like this all the way up. And if you don't buy it, you may miss a move. Okay. But what if it corrects down or if it goes flat for 3 years? Look here. Consolidation over 3 years. What's then? The capital is stuck. Are you happy with that kind of risk? These are the secrets nobody tells you, okay? Out there are people who try to sell, brokers who try to want you to open accounts, people try to sell you analysis or research or indicators or YouTube videos, whatever it is, they all have a vested interest. I'm trying to tell you the truth, okay, to enable you to make better decisions. And yes, I have my own, I'm specialized in Forex. You will not find anything remotely to our work here on this channel in Forex anywhere, okay? Like the market causality, the live tools. Look at that, This is unique. And I've shown you now what you can consider in terms of your overall asset allocation and what you cannot. So yeah, visit our website, www.smefx.com. On the forum also we have not only Forex, we also have sections for other asset classes. Participate, okay, subscribe, post, write, okay? Join our movement. And if you, if you want, if you have made an analysis for yourself and decisions, post it, say, look, this is my my analysis, this is my strategy, I will do this and that. Post it so you can talk to other people and hear their opinion. I think that's a good idea. Doesn't cost you anything. Okay, I think I was able to get my points across. Thank you for your time. If you weren't able to watch all parts of the video, go back and watch them later. Okay, I think this is what I've shown you here is, in my eyes, basic financial knowledge and understanding. Okay, it's something I would think everybody should know, no matter what you do in the end. Okay, and be aware of those options. Now, somebody who watches this may say, well, you know what, I love real estate. I put my money into a multi-family house and I maintain it and I earn rent there and I feel more in control because it's something you can actually touch. Fine, do it. Just be aware that there are other options out there you could consider, maybe in the future. Or you're someone who does a startup and says, you know what, all or nothing. I'm confident in my idea. If it works, it will become big. And you know, I will survive any drawbacks. Or you're someone, you know, who says, look, I love crypto. Crypto made me rich. I'll stay with crypto. Fine, no, nothing wrong with that. Or you're someone who says, you know, I love trading. I want to become a forex trader. Okay, then walk the walk. Okay, it's the most complex thing. Of course, in Germany we say it's a Königsdisziplin, the king's discipline, because this is a real trading, you know, if you do short-term trading in a VIX. But be aware that this is a very, very complex activity and you will lose unless you have really understood the game. Okay? Anyways, I don't want to go overboard. Stay safe, everyone. Let's see what the future brings. Goodbye.